go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast. We are recording on location at Wealth Management Edge in beautiful Boca Raton, Florida. Very fortunate, very lucky to be here. It's been fantastic. You know, until recently, diversification has really come under fire. A lot of times when the U.S. equities are roaring, then people wonder, why are we invested in international? And then at the same time, when Magnificent Seven is controlling markets, driving markets, people question, why are we invested in the entire stock market? And in 2022, nothing works. So diversification's really come under fire. Well, I have the perfect guest with us today to talk about diversification, and it's Carlos Diez from MarketGrader. Carlos, thank you so much for coming on the show. I really appreciate it. It's an honor. Can you tell us a little bit more about yourself and MarketGrader?
Yes, thank you for having me. I would say also welcome to sunny and very humid South Florida. I am based down the road in Miami, so it's good to be here. Good to have you here. So a little bit about myself and a little bit about the company. I think understanding a little bit of my background helps understand why MarketGrader was born and where it came from. I was born and raised in Colombia. I lived there until I was 17. And one thing that I remember distinctly is I had always been very interested in understanding how the world worked, how business worked. And I remember from an early age always asking my dad, who owned these companies? And I was asking about the airline and the, beer company and so forth. And it always tended to be the same sort of families, right? And then over time, I discovered that a lot of the wealth, a lot of these large companies that everyone looked up to were concentrated in a few families. So this will be relevant to, the birth of MarketGrader later on.
Yeah.
I moved to the States when I was 17. I finished high school here. I went to school in California, and I was in college in the late 90s, so at the height of the dot-com boom. And that also made an impression on me for a number of reasons. Obviously, I saw what was happening in terms of investors' access to markets, newfound access to markets through online trading platforms and the like. But at the same time, I saw the excess that came with that, access. So I wanted to do something in finance, and then and obviously very young, still figuring out what I wanted to do. And I thought it would make sense to build something that would analyze publicly traded companies to give investors information about those companies without expecting them to do a thorough financial analysis of the stock. So that was the genesis behind MarketGrader. The idea started in 1998, 99. And then the company started at the end of 1999, and we launched the first MarketGrader research platform and the first MarketGrader indexes, part of our business, in 2003. That was a bit of the background story behind this.
I love this story, and it's interesting you brought that up. I think education is so important for younger kids, and we have a family member who's really big into Disney. So to help educate her about investing, we were like, well, why don't she had some extra money, buy Disney? So she would go around Disney. We took her to Disney World, and she was going around saying how she owned it. She owned everything. It's a great learning experience.
That's such a good point. I have two nieces that live in California. They're 14 and 10, and I have the same conversations with them. The older one is also sort of interested in understanding how things work, and she's interested in understanding how money works. And very interested in understanding who owns what. Like I used to be at her age, and I tell her, here, everybody owns or can own anything. I said, you like Disney, for example? Actually, she is a Disney shareholder. The companies that make, the watches that people wear, the phones that people carry, the clothes that you wear, you can own that if you want. Over time, it's important to understand how good those companies are and whether you want to own them or not.
Yeah, I think it's a great learning experience, and there's always a gap, I think, in education about financial education and investment. So I love that story about as a kid. At MarketGrader, your investment philosophy is GARP plus quality.
Yes.
Can you tell us a little bit more about that and kind of where you came up from that with that?
Yes, so if you backtrack a little bit to what I was describing before, when the company started, the first thing I said is like I have to figure out how to analyze a publicly traded company,
Okay,
right?
yeah.
Based purely on reported financial statements.
Yep.
And so I did a lot of research and figuring out how to go about understanding how well a company is doing, regardless of what they do, their
Yep.
size, their business model. And then I read a lot about growth investing and value investing, and I felt it was a false choice being given to investors
Okay.
to be either growth or value. I started reading about GARP, about very successful GARP managers, and it made a lot of sense to me to understand how you could own a company that is a growing company at a reasonable valuation,
Yeah.
and how the impact of the valuation at which you buy is significant for your long-term returns. So that's sort of the GARP part of MarketGrader.
Okay.
And then quality, in understanding how a company does, if you're looking only at numbers, you're not looking at any qualitative factors. You don't know how good the product is, if management is good or not. You're just looking at what the company reports in their financial statements. And I believe that you can glean from that if a company is consistently good at whatever it is they do,
Yeah.
providing banking services, building software, drilling for oil and gas. You can find consistently good companies that do well by shareholders. So that was sort of the quality aspect of it. So today we think of quality as a factor when you think about investing through or in factors. Back then I didn't see it that way. It was just like, how do I put together a series of formulas and indicators that allow us to understand how good a company is? So in summary, we have MarketGrader rates like 41,000 companies globally.
Okay.
Everyone through 24 factors or
Yep.
24 indicators, 6 of which are growth, 6 of which are value. That's the GARP part of the analysis. And then 6 profitability and 6 cash flow, and that's the quality part of the analysis. So we're looking for companies that have well-rounded indicators or grades
Yep.
across all of these.
Do you find, as a true fundamental investor, you really look at the analytics and, like you said, the financials? Was it difficult following the COVID when it was so much meme stocks and fear of missing out, and like it got really away from the true fundamentals? Was it a struggle, do you think, or?
Not for us, not for me, because I think fundamental investing is timeless.
Yeah.
You can find high quality companies pretty much anywhere at any time. If anything, when you see those sort of trends, or especially when you see market dislocations like you had in early 2000, definitely 2008.
Yeah.
To me, that spells opportunity, because if you're able to tune out the noise, if you're able to not discount, but for a moment set aside the qualitative story and just focus on the fundamentals, that's when you can pick up great companies at great valuations and do really well in the long run.
I love that. But yeah, early in my career, it was during the 2000 .com crisis, and the group I was working with, they're like, this is a great opportunity. Where there's crisis, there's opportunity, right? And it's always kind of been with me through my career.
No question.
So let's talk about diversification. So I said at the open that diversification is under fire. Do you think it's coming back now after this year? Internationals finally outpaced U.S. and
So I don't think it was ever dead, or
Okay.
I don't think it was ever gone. Because I knew that we might talk about diversification today, I did a little bit of digging around to see how international markets have done in the last 10 years. And it all depends on how you define international markets, right? Typically, people will follow a widely held benchmark or widely followed benchmark, say MSCI emerging markets for emerging markets, and MSCI EFA for Europe, Africa and the Far East and the Middle East, etc. So I found that in the last 10 years, international markets, if you select the right companies, have actually done really well. So we have, MarketGrader's business is broken down into two halves, research and indexes. So we rate, like I said, 41,000 companies. Only about 14% of those, or 5,000 plus, are rated by, in our system, but they're spread around the world. So our point is that great companies exist everywhere, right? And then how do you find them and how do you own them? So we built indexes that select only among those highly rated stocks, be it in the US large caps, small caps, all sectors, developed markets, emerging markets, you name it. And we put together indexes based on that selection and then just track them over time. And having said that, the point is in the last 10 years, and this is through May, 10 years through May, the US market has given you, on a total return basis, including dividends, a little bit over 12% per year. Phenomenal, right? Our indexes across developed and emerging markets have given you between 10 and 12% per year. Not always upward years for every single market, but I looked at broad emerging markets. I looked at individual countries in developed and emerging markets. I looked at Europe. I looked at Japan. I looked at Israel. I looked at Australia. And if you select high quality companies in those places and own them passively, there isn't any qualitative selection of the companies. It's all based on our GARP analysis. You can do well. So that's a long-winded answer to your question to basically say diversification has been alive and well across global markets for a while, and it will continue to be, just like the US will continue to do well.
No, I agree. I've done a lot of research with Zephyr, our investment application, and while some periods it's like, why, international is a drag, but you have to really look at the longer time period and work together, right? You shouldn't have to be, trying to time the market between domestic and international. You're going to lose that game. So, and like you said, over the long term, you look at the long term, it can be a good opportunity and a good diversifier for your portfolio.
Absolutely, especially if as an investor you're trying to predict macroeconomic factors and how they're going to impact your investments. No one succeeds at doing that. Not even the Fed can tell you what interest rates are going to be 2 years out, right? So the best thing you could do is just focus on owning quality companies, having, like you say, a long-term time horizon, and doing so passively, in our view.
Very, very good point. And then the uncertainty too. If you would have asked me at the beginning or at the end of last year if international would have done well this year, I'd have been like, no, because of tariffs, right? I'd have been like, tariffs, it's going to be a headwind, and then that's completely wrong. Because international, Eurozone's outperformed.
Has done really well, yes.
So, two of the biggest ETFs are the SPDR and VOO. Very market cap weighted, linked to the S&P 500. Are there, opportunities there or risks there, maybe setting the investors up for disappointment by investing in, a market cap weighted index or a ETF like the SPDR?
Not if they have a long-term investment horizon. If you have a long-term investment horizon, I'm thinking, I'm saying 10 years plus, then owning either one of those ETFs will be perfectly fine. They own the broad U.S. market. They lean large cap growth because of their weighting. So in a way, if you invest in them today, you are making a quasi-active bet in large cap growth. And you're buying at a relatively high valuation. So if you go back to, going back to when MarketGrader was born, if you go back to early 2000 when the dot-com bubble deflated or began to deflate, if you look at the returns for U.S. stocks between then and now, the best performing, if you look at the broad benchmark, so large, mid, small, growth, value, the best performing index of all was the equal weighted S&P 500. It beat the market cap weighted S&P 500, but by something like 350 percentage points, which is very significant. If you look at large, mid, small, the best performing segment of the market to date by far was the Russell Midcap, or even the S&P Midcap. I think Midcap is sort of the sweet spot of the market. Why what's the point of that? The point of that is to say that you never know who's going or what segment of the market is going to outperform in next year or two.
Yeah.
Factor investing definitely plays a very significant role in your returns.
Okay.
And you can make a lot of money with factor investing, provided that you have some degree of foresight. But who's to know if large or small is going to do better
Yeah.
next year, the next 3 years, or growth or value, right? So the way we look at things is it's important to be diversified within a broad market exposure, right? And we have equally weighted indexes and market cap weighted indexes within the MarketGrader family of indexes, and then they perform similarly to the market cap weighted or equally weighted indexes that the market has, but tend to do a little better because of the quality of the companies in it. In the US, MarketGrader is probably best known for the Barron's 400 index. We've been partnered with Barron's since 2005 or so.
Okay.
We built an index called the Barron's 400 with them. It has the best 400 companies in the MarketGrader system based on our rating, and it has done incredibly well overall this year. So going back to the example I gave you, it was the equal weighted Barron's 400 index was the best performing index in the US that I looked at since early 2000 when the dot-com bubble deflated, like I said. So why? Because it wasn't overly concentrated in any number of stocks or any segment or any type of stock. It was broad and it just did well over time.
Yeah. I'm glad you brought that up. It's interesting doing research in Zephyr. I just did a diversification article that I'm about to post, but it compares cap weighted and the equal weighted S&P 500 during times of uncertainty or maybe down markets, and the equal weighted performs better during those time periods, and the cap weighted during the run up during the bull markets usually outperforms. Is there a reason why? Is that because of market cap concentration? There's a high concentration in the winners for market cap, do you think?
Yeah, definitely concentration, definitely the size factor, the size and the growth factor.
Yep.
So when you think about pure passive investing, a true passive investment in the U.S. equity market is a market cap weighted, broad index, say the Russell 3000. The Russell 3000 is very highly correlated. It's almost the same exposure as the S&P 500 because its performance is driven by the larger names in the index, right? Doesn't matter if you have 500 or 3,000 names, it's pretty much the same index. There's nothing wrong with that. Like I said, provided that your time horizon is a long one. But if you're buying that today, you are singularly exposed to the more expensive names, right? So yes, in down markets, when the market corrects because of valuation, which is what happened in 2000, then you're going to have bigger drawdowns in those exposures, right? And not as much in the market cap, in the equal weighted indexes, right? When markets correct for other reasons, like 2008, which is mostly a liquidity event, everything just goes down. Correlations go to 1 across most equities and asset classes. So yes, a lot of the drawdowns in periods of stress when the market is overvalued has to do with the size of the companies playing a significant role in the performance of the index.
It's interesting. You go back to what you previously said about mid caps. I just had a conversation about mid caps, and you often forget about mid caps, right? It's always about large caps or small caps, and seems to me like mid caps are the forgotten child. But when you look at performance, and you brought it up, mid caps performance over the long term is very attractive, and it shouldn't be forgotten.
I think, like I mentioned before, I think mid caps are the market sweet spot for a number of reasons. So again, look, the benchmark that you look at is important. So first of all, if you look at small caps, if you look at the Russell 2000 as a small cap benchmark, probably the most widely used one, I think it's highly imperfect because there's a very large percentage of those companies that are not profitable. So why would you want to be exposed to that to begin with? So maybe you can begin with a smaller group of small caps to look at, right? If you look at the large caps, so say the S&P 500, then you have the concentration problem that we described before. As the market gets more expensive and more people participate in that ongoing rise of the market, then you are forcibly more invested in the more expensive names and underinvested in the less expensive names. Mid caps sit in the middle of that, right? So mid caps are interesting because they are large enough that they have scale. Obviously, they have access to capital, and their ability to grow into larger caps is greater than maybe small caps, right? They don't have some of the shortcomings of smaller companies that maybe don't have the same market share. Maybe they're very focused on one narrow part of the market. So yeah, that I think, historically, like you said, mid caps have been sort of the sweet spot. And if you look at the large cap darlings of today, they were all mid caps at one point, right?
Yeah, exactly. And during that conversation, we talked about NVIDIA. NVIDIA, I think it was like 7 or 8 years ago, was a mid cap.
Yeah,
right.
They had a couple of near-death experiences not that long ago, and they were able to grow out of those issues. So yes.
Yeah. So let's go back to fundamental investing, and it's interesting. We talked briefly about emotional investing or fear of missing out during COVID, and we know investing is very behavioral. How can you remove the behavior and the fear of missing out from fundamental investing? How can you kind of really separate those two when doing your research?
So for us, the analysis is easy from a behavioral point of view because it's all quantitative, it's all computer based. So we have a system that is recalculating all these indicators that I describe every single day for all these companies. So the scores are what they are based on company financials, based on company fundamentals. So that, and then the output, the scores that are used to build the indexes, produce this objective index or investment vehicle that has no emotion involved in it, right? What you do with it is where the behavior comes into play, right? You can have a great index, Barron 400 is a great example, and then what you do with it, maybe you panic and you sell when everyone's selling, or maybe you get overly excited when everyone's buying. That still goes back to your own bias, right? So there's nothing you can do about that. We are humans, and we're always going to act as humans. Often asked, when friends of mine that are not in the business or in investing, ask me, what does it take to be an investor and a successful investor? I tell them, what? I think the role that skill plays is a lot less than people would make you think. The role of temperament in successful investing is a lot higher for professionals and individuals alike than people like to advertise. So. Temperament is important. Like you said before, if you're able to be contrarian, you're going to be successful. If you're able to be patient and maybe tune out the noise, you're always going to be successful. And if you do it through, broad, passive indexes, in our case, the ones that we select based on our analysis, you're going to do really well in the long run.
Yeah, I get those questions all the time, and I am not a stock picker at all. If I'm out at a social gathering, like, Ryan, what's the next best thing? It's like, all I say is diversify, and they hate that answer. They want that next big stock tip and stuff like that, and it's hard.
I fall into that trap myself all the time. I'm looking at the data, I'm looking at our ratings, and sometimes I just buy into the story and I buy a stock, and then sometimes I do well, sometimes I don't. Personally, I invest most of my money in the Barron 400 ETF. That's sort of the backbone of my exposure, but around it, I like to buy stocks here and there, but it's a relatively small percentage of my overall investment pool. So, but I do it all the time.
Yeah, it's difficult. And I always say, go to an ETF, buy a passively managed ETF, start there, and then, maybe have a little bit of play money. But it's always a question that I get, and my answer it always disappoints. Let's talk about opportunities real quickly. So GARP plus quality, or growth at a reasonable price plus quality. Based on that, where do you see some opportunities? International, within the U.S., just maybe regions or sectors?
I think the U.S. always has opportunity. I would never discount the U.S. as a probably very attractive or one of the most attractive markets to own in the world. I would never suggest anyone to divest themselves from U.S.
Yep.
equities or to shrink their U.S. exposure significantly. So, and in U.S. it's across the board.
Yeah.
Oftentimes our own system is a little bit contrarian because it's looking at the numbers, and so you see that when maybe oil and gas companies are unloved by the market for
Yeah.
various reasons. If the companies are doing well and the stocks have been sold off, we tend to like that, right? When I say we, the system tends to like that. It tends to pick more of those, right? Technology, I know everyone keeps coming back to technology, but technology is not just a single sector where you say, you should own technology. Technology permeates every sector and everything that we do. So technology is always going to be a perennial, large share of the investment opportunity in the United States, and that's going to always continue to be the case. So, I'm not trying to pick specific sectors, but they're just trying to identify sort of the dynamics behind how this system works. Overseas, there's a ton of opportunity overseas. I've always been a fan of emerging markets. I know that China has been a challenging place to own. China's very broad and deep market. There's excellent companies in China, so obviously they're caught into a lot of the geopolitics of the moment, and it's hard sometimes for foreign investors to own China. But I think there's a lot of innovation coming out of China. China's attractive. India is very attractive to us. We have a couple of clients that have some India ETFs tracking MarketGrader India indexes. India has an incredible opportunity right now to be really, really a very significant part of like global equity allocation. I think it's a market that people are under allocated to. They have a huge demographic advantage over China, over other emerging markets. So I like that a lot. But even developed markets, there's attractive opportunities. Israel is a market that I've always liked. There's always a lot of innovation, ingenuity coming out of Israel. Again, I think opportunities abound. So
especially when you look at the long term, right? Focus on the long term. There's a lot of opportunities, and
people that are running and building companies in India or Israel or the Middle East or Europe are no different from you and me or any U.S. manager. They're trying to grow their business, do well, return capital to their shareholders over time. So if you're able to identify and own those companies, you will do well in the long run.
Lastly, is there something that people just aren't talking enough about? Maybe they just don't realize, or just something that you think is top of mind that should be a more important talking point?
I would say, I would actually maybe flip that around a little bit and just what are the things that everyone is talking about that maybe are not as important in the long run, right? That's the way I think about things, because we tend to get caught up in the day-to-day, especially today, like nowadays. You have access to information instantly about anything that you want, right? And you're being sent notifications about political events in Europe and the United States and Asia, and obviously tariffs, and with the current administration is like a fire hose of information coming out, right? I wouldn't say that those things don't matter. I would say if you take a step back and look at the long arc of time of history, we've always had periods of uncertainty, periods of political discords, and in the end, we always come out okay. The U.S. always comes out okay. People always sort out their differences. And from an investor's perspective, if you stay invested, if you own high quality companies, if you do it passively, you're going to be okay. So I would say what matters is to take a step back and not get too caught up in the day-to-day of all these things.
Fantastic way to end this conversation. Thank you so much for coming on the show. Fun conversation. You shared a ton of great insight. Carlos Diez, CEO of MarketGrader. Where can we get more information about MarketGrader?
MarketGrader.com. People can subscribe directly to our service, to our research, and there's also a lot of information on our indexes there. Barron 400 ETF, there's an ETF tracking the Barron 400 equal weighted index. BFOR is a symbol. That's a good way to have exposure to the kind of companies that I was talking about. And yeah, MarketGrader.com. So thank you so much, Ryan. Thanks for having me.
Thank you, everyone, for watching. This episode is Zephyr's Adjusted for Risk podcast on location at Wealth Management Edge. You can watch all of our other podcasts on the Zephyr YouTube channel and Spotify. And please be sure to like and subscribe those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your week.